partners here at Endowus. Very happy to have Yulin with us today.
Hi guys, this is Yulin and I am really happy to be here again after two months or so. Yeah, very happy to be back.
Okay, and so today's session is really a review of 2020. So we'll review overall markets and Endowus portfolio performance. And we'll also talk about some insights about 2021. We're really excited to be back with you today. We will just some housekeeping issues on the slides. We'll be moving on to a promotion that we're having. It's related to our Endowus Cash Smart solution. For those of you who are not familiar, Cash Smart is a solution that offers higher yield and relatively safe investments so that you can generate higher yields better than any bank deposits out there. We're doing a special promotion with one of our partner fund managers, Lion Global, where if you open an account with Endowus and fund the account with our minimum investment of 10,000, then we will give you $100 of unit trusts in Lion Global all-weather, all-seasons fund, which will be opened up in a Fund Smart goal for you in the Endowus account. So the amazing number, $100, I think, literally in cash, whenever you open up an Endowus Cash Smart account. So please go ahead and sign up. It's limited to 2,000 clients, and so it'll probably run out pretty quickly, but if you move quickly, you'll be able to get that for yourself and for any of your friends. Please use your referral codes. If you go into your account, on the bottom left side, you can see your account details, and on it you will have referral codes that you'll be able to share through social media or communication channels like WhatsApp, etc. We have a very brief disclaimer, and then we'll move on to the next page, which is our usual slide on how to subscribe to the Endowus YouTube channel. You just go down there. There's a lot of things underneath today. So there's the regular stuff. You can sign up for the YouTube channel. You can actually go in and set up a call with one of the MAS licensed representatives here at Endowus. So you can consult with them. You can book a 15-minute consultation and then discuss with them, or any other communication channels that you want to. You can go to our website for educational content on Endowus Insights. Or any other contents about how to invest and get going with the Endowus platform. But we're really, really excited as we begin the new year on this new event that we will be hosting next week. So please go below to the Eventbrite sign up. We have a massive event. It's going to be really exciting with many of our partner fund management companies. But also institutions like SGX, like CPF Board, like the Singapore Green Finance Center, and also NUS and SMU universities, as well as some of the most popular and widely recognized financial blog sites and communities like Seedly and Dollars and Cents and the Woke Salaryman. And we'll all be there to present to you, to give you insights and also market outlook and personal finance guidance as well. And so the details are here. Please sign up in the Eventbrite below. And if you see the next slide, you can see who the speakers will be. Oh, sorry, you skipped that one. The many wonderful speakers that we have managed to get for you. The CEOs of the three largest domestic fund management companies will be hosting a session on market outlook and business outlook of where the investment community is headed. We'll also have a session on ESG. Really excited about sustainable investing, how we can do that better. It's very aligned to Endowus's mission and vision, and we'll be launching. Please look out for the launch of a multi-manager, multi-asset, across the whole risk spectrum, equity and fixed income, ESG sustainable portfolio. That's coming to you very soon, and Yulin and I and other people in the team have been working really hard to get that out so that we can launch it. And we'll have a panel on the ESG side where Susan So, who's the co-head of Asia Pacific and CEO of Singapore for Schroders. Schroders is one of the participating fund management companies, one of only two, together with Fullerton, where Jenny is CEO. And she'll be representing, as well as Dave Fernandez, who's an SMU professor, but also the director of the Singapore Green Finance Center, and Dave Smith, who's from Aberdeen, the head of ESG there. We also have Boon Chai, the CEO of SGX, Chin Heng, the deputy CEO of CPF board, Joe Cherian, who's a professor and in US, but also sat on the CPF panel, advisory panel, many years ago on how to make CPF better. And obviously we have our fan favorite Lou, the founder of 1M65, who are making millionaires out of Singaporeans through their CPF. We also have obviously Tim Ho, Ken Low, Riming, the three most famous, most well recognized, and the most popular speakers on the financial blogging community, who we collaborate very closely with, coming to give you advice on personal finance matters as well. So please sign up once again below on the Eventbrite and join us next Thursday.
Yeah, and I just want to jump in and say this is a really exciting and I think a very unique event in Singapore. It's very rare for like individual investors to have access to this number of speakers and on such a diverse range of topics. So yeah, really excited, and personally I look forward to that a lot as well.
Yeah, wonderful. And most importantly, it's free.
Yes.
So please join, sign up. It'll be virtual, so you can join us from anywhere in Singapore or abroad. It will be live on YouTube Live and Facebook as usual. Okay, just housekeeping on Slido. So obviously we are starting to use Slido. So yes, the chat room is there on YouTube Live, but please, if you have questions, let's use the Slido poll so that we can, have other people who are in this session today join in and communicate to each other, but also share questions. And you can vote them up, so the most popular questions will be answered first. So please, please make an effort to go into the Slido and pose your questions there, and we'll be following the questions on Slido itself. Okay. So with that, for those of you, I know that this is the first session this week, and we have many people joining us, but also we realize that many people are actually joining us for the very first time. And so I think that it would be good for us to maybe do a quick introduction on Endowus. So our mission, as you know, is to help people invest better so they can live easier today and to live better tomorrow from now here towards retirement. We were set up to really focus on the biggest problems in wealth and investing. When we're trying to help people save and invest better, it means solving problems and pain points that exist in the industry. We all experienced it ourselves, trying to invest our own money, and that was one of the reasons why we set Endowus up. But the real issue is the fact that there is a lack of advice for especially individual investors, and a lack of aligned advice. There's also a lack of access to products and high cost, and this leads to poor outcomes. And I think this is the biggest challenge that we face, especially as this generation ages and we have major challenges in wealth and retirement adequacy. And the solution that we have created is a digital solution, digital first, which is great because it's easily accessible, but also it's low cost. It's hyper personalized and holistic. So we are the first and only digital advisor for CPF money. We worked really hard and built a very unique technology stack that enables you to do everything seamlessly online. Everything before was offline. We even had to convince the 3 local banks, the agent banks, to create online access to CPF investing. So we worked really hard with these existing players, existing regulatory frameworks, working with the CPF board to enable this digital experience. And that is why we are still the only digital advisor for CPF. And therefore, we're the only platform where you can invest your CPF, your SRS, and your cash savings all in one place. So it's a total wealth management platform where you don't have to go anywhere else, but find the best-in-class products. You know that we are fighting for you to lower the fees to the lowest possible. If we receive any rebates, we 100% rebate that back to you so that you achieve a lower net fee and a better return. So this was created, this Endowus platform was really created for you, and it was created so that you can meet all of your wealth needs. And three things that are most important to us is advice, access, and cost. So advice in the form of better, planning, evidence and scientific based and holistic advice across all of your source of income and savings. Access in, really creatively solving for problems, accessing institutional share class that was not available before. CPF, passive index investing, which was not available, we make it available to you exclusively through Endowus, and costs that were unheard of before the arrival of Endowus. So through all of those measures, we're trying to improve outcomes. And we partner with the best in class companies and fund managers so that we don't have to reinvent the wheel. So these are all household names that you're familiar with: Vanguard, PIMCO, Dimensional, BlackRock, and many others that we're working with. And we select and curate and screen for the best products. We work to get those products onto the platform. We created the Fund Smart platform so that you can get access to this at the lowest cost and efficiently. And education and financial literacy is so important to us. We did this even before we began a service, commercial service. And so, one of the efforts that we're doing is events like next week, where we will be presenting to you many of these insights and completely for free, easily accessible, and oftentimes, produced in a way that is easier for you to understand and digest. So hopefully that will be very helpful. Okay, so we'll move on to the core topic today. First one, we're going to start with a 2020 year in review. So you know what happened last year. I'm sure no one slept through last year. It was a very difficult period for everybody. We struggled through it, but we got to the other side. And to be honest, we've all been kind of surprised, right, on how robust markets have been and how quickly they recovered. And we had a very strong end to the year, and we're having a relatively strong start to the year as well. So I hope that people are enjoying good returns in markets, especially if you invested through Endowus. This is a very quick picture of what the representative stock market did and what the representative bond market did. And many people talk about how fixed income also fell, but obviously this clearly shows that fixed income did what it was supposed to do. And equity markets, not only fell dramatically, but recovered quite quickly to reach new highs. And last year was not a normal kind of cycle. It was the fifth largest fall, peak to trough of 34%, was the fifth largest fall in the history of mankind. And the massive volatility in daily returns. So this is a very interesting table which shows you daily returns in markets of 1% or more, or 2% or more, or 3% or more, etc., etc. And basically, 1% or more includes all the ones underneath. And then if you look at the 3% or more, which is not a very common occurrence, it only happened 28 days last year in 2020, but that's 11% of the total trading days last year. And the market moving more than 3%, 28 times in a year, 11% of the total trading days. So 1 in 10 trading days, the market moved more than 3%, is a ridiculous and phenomenal number. It's more than 4 times the average historically. And it just goes to show how volatile and tough the market was in trying to predict and also trade these markets. And if you compare to 2008, it's almost at that level, even though, as you can see in the next chart, the 2020 crisis was a micro, compact kind of, shock to the system and a rebound. And it all occurred within a 3.5 month period, the rapid fall and the recovery, which is very different from what happened in 2008. So the fact that the markets moved in that way is pretty amazing. Just a quick review of the 2020 full year performance, just out of fun. We've been using this chart to show all the various asset classes and how they moved last year. So the left side is the MSCI ACWI Global Broad Market, US markets, international EM markets. And then we put in some interesting ones, the bond market as well, but gold, obviously, but Bitcoin, Tesla, and some REITs and the venture capital and private equity indexes as well, and what they did throughout last year. And it's interesting that a lot of them obviously ended the year positive, but the real outliers were things like Bitcoin and Tesla. So there is a lot of speculative froth out there, and venture capital also did quite a lot as well. Xingxi, next slide. So intra-year peak to trough, this is the maximum drawdown. And, it's interesting that the biggest winners of last year were also the biggest losers during March. So Tesla and Bitcoin fell the most, 60% plus, which is a massive fall in Tesla share price, and goes to show that it's largely liquidity that is driving a lot of this price movements. But also things like wine and gold and global aggregate bonds fell by 10% or around that level. So it was quite defensive. And if you just move to the next page, this is from the bottom of the market to the end of the year. So even from that end of the year, we've gone up a little bit more in general, but basically you can see that markets have actually done quite well. So the ACWI stock market went up 71% from the bottom, which is an amazing number. US small caps actually did the best. It was up almost 100%. And you can see where Tesla and Bitcoin ended up from the bottom. Obviously, from the lows, after it fell the most, it's bounced back. So the next two charts I want to show so that we can remove the two real outliers, Bitcoin and Tesla, and show what it looks like for normal index, asset classes. And you can see that for the full year, US small caps and EM and Asian stocks actually did the best, which is really interesting, together with gold. And then the next page shows that from the bottom, once again, small caps and emerging markets actually did the best. And REITs actually caught up a little bit, but many REITs actually ended the year still down for the year. With that, I'm going to pass on to Yulin to discuss some of the details of market movements and what happened in this year in review.
Yeah, so we have seen kind of the broad performance across different markets, and of course within last year we saw huge dispersion in the performance between different sectors, and this is a summary of how each sector performed. So not surprisingly, the winners, they are kind of more tech heavy. So information technology, this sector includes, for example, IT software and services and semiconductor sector, and they have all done pretty well last year. So one example that we are all familiar with we mostly kind of gained familiarity with it during COVID, that is Zoom. So Zoom belongs to this sector, and in 1 year's time, it not only gained fame across all the users, but it also gained 400% return just in 2020. And then consumer discretionary includes, for example, internet retailing, and the names are, for example, Amazon, Alibaba, they all fall into this category, and some really amazing numbers. For example, it's Pinduoduo, which is a Chinese online retailing that kind of sells farmers' produces directly to consumers. So obviously, this has become increasingly popular during COVID as people order online, and they gain over 300%. And then we obviously had some losers in terms of performance, and energy sector was really wreaked havoc last year. I think a lot of us, we probably have forgotten, but actually if we think back, in April, oil futures price dipped to negative for 1 night. And that was because COVID really smashed the demand for oil, and the suppliers, they kind of panicked, and they were even willing to pay buyers to take oil supply away from them, because they're worried that there will be not enough storage for oil. Yeah, and some other sectors like real estate, of course, we saw that Asian REIT did well, but actually on a global level, again, because of the reduction in consumer spending as a result of COVID, it didn't do very well overall. And in terms of financials, banks, they got their margins got pretty squeezed because of the lowering interest rate across global, which we will discuss later as well. And the next slide, it just kind of compares the return between S&P 500 and NASDAQ is a very tech-heavy index. So actually, the outperformance of tech stocks, it's not very surprising, and it's been like this for the past 10 years. So there might be something structural there, as technology is really transforming people's lives. And so this slide is a summary of kind of different quarters performance of different markets. So US market and the rest of the world and emerging market. 2020 was an interesting year where the first quarter we saw this huge volatility and market crash. But then actually later on in the second half of the year, all of the major markets, they bounced back very strongly. And those markets that have gone down the most have bounced back, rebounded the most as well. So that is emerging markets. So we can really think of 2020 as kind of a year broken down into two halves. And the beginning of the year, it was negative performance in Q1, and US equity was actually the most resilient market in the first half. And also global bond market was still positive even during the COVID drawdown. So that again proves the point that bonds still plays a role in diversification and in kind of cushioning the volatility in equity markets. Whereas later on, emerging market bounced back really strongly. So we just slightly touched upon fixed income, and the next slide just shows us how fixed income can also experience large volatility, and there has been also a huge dispersion across fixed income sectors. Apparently global high yield, which is the most risky fixed income sector, it experienced the largest drawdown over, it's almost about 20% during March, but it bounced back really strongly afterwards. And it's really important to note, actually the global aggregate index, the global aggregate treasuries index, which is government bonds, it dropped, but it never kind of dropped to negative area. So it is still a very kind of protective asset to hold, to be more defensive, to protect to provide a defensive aspect for your portfolio. And the next slide summarizes kind of the fixed income market performance across maturity and across quality. So in 2020, as a whole, actually high yield, long maturity bond, so the right bottom corner, it performed the best. It's up 23%, so it even outperformed equity markets. Whereas, the lower end treasury, of course, it's the safest, but it also returns the lowest as well.
Okay, thanks Yulin for that. I do want to apologize for the noise. We are trying our best with these mics, but yeah, if you can try on the screen to increase the volume, the YouTube volume, as well as your computer volume, then hopefully that will improve matters. But we'll speak directly into the mic so that we can make that better. Also, I forgot to mention that we have on Slido not only the questions, but we have a poll going on. So really fun poll that's going on, and it really is just asking you, what made you most money in 2020? Is it stocks? Is it bonds? Is it Bitcoin? Is it Tesla? Or Endowus? Or is it government payouts, government checks that made you the most money in 2020? So that's ongoing right now. So please vote on that. Keep voting. We're gonna give you a result later on. And we have a second poll just to make it fun. If you've answered, then you can actually see the question and the answer as it starts moving. So the more people answer, we have 25 people who answer so far. So get on Slido, guys, and please help us with this fun questionnaire that's going on. Moving back to the slides, we're gonna be talking about the Endowus portfolios now. And we published this report, which is widely available and also available on our Endowus Insights pages, is our year in review, where we talked about our business, we talked about our portfolios, but we also talked about what our clients did. And this slide is really interesting that during the January to September period, and really focusing on investment behavior and asset flows during the crisis in March, February, March, and April, clients investing versus redeeming did obviously fall a little bit. So people held back on investment a little bit, but the redemption didn't really go up meaningfully. It slightly went up in March, but then came back down, and it has remained relatively low and within normal kind of volatility. And then the next slide, which is really interesting, is how many times did clients log in? How many clients logged in more than 10 times per month? So 10 times a month is one every 3 days. So in 10 times or less, per month. So it's really not that often, right? Some people would be checking every day. Now we have a mobile app, so maybe you'll be checking many times a day. But during March, we actually didn't see anybody log in more. They actually logged in less in March. And so in April, it's 92%. So 92% of people logged in 10 times or less. So higher number means that you actually logged in less time, and which means that the Endowus clients are the right type of clients. They seem to be really investing for the long term, investing in the right way, behaviorally. And we hope that these education sessions and continuing interaction with our clients, and we always welcome interactions, emails or questions, and we try to respond as fast as we can. We are only human, so apologies to anybody who may feel that we're a little bit slow. We have actually had a very strong inflow, new clients onboarding, hundreds and hundreds a day. So basically our CX team has been stretched. We're hiring, so hopefully that will ease and things will improve, but we're trying our best. But please, reach out whenever you want, and we can try to respond as soon as we can. If we go to our portfolios, we're going to start with the CPF portfolios, and then we'll go to the cash SRS portfolio, which is the same portfolio at the moment. As you know, our CPF portfolios includes, Vanguard indexed portfolios for S&P 500 and also global equities. So we brought those index passive funds into CPF for the first time creatively. It's the only passive index fund available in the CPF investment scheme. It's at the lowest cost achievable, so 40 basis points, and all-in cost is well below 1%. It's actually below 90 basis points. It's 0.8 something percent for 100% equities. And we built a portfolio across 100% equities all the way to 100% fixed income. You'll be glad to know that the 100% equity portfolio achieved a 15.7% return, and this is net of all fund level fees. Net of the fund level fees, the TER, so it's a very broad measure, so all expenses included. The only thing it does not include is the Endowus fees, which for CPF would be 40 basis points. Even if you take that out, it would be 15.3. So it beat the MSCI All Country World Index by more than 1%, so a good performance. But what was interesting is we expected the fixed income to not do this well, but actually it did tremendously well. And even against the global ag index or the JP Morgan emerging market bond index, which achieved 5.4% and 5.9% respectively, a 100% fixed income portfolio, which is globally diversified, with a Legg Mason global bond portfolio, wonderful Sing dollar denominated fixed income or Sing dollar hedged fixed income products, achieved a 6.7% outcome. So if the 100% equity outperformed and the 100% fixed income outperformed, everything in between would have outperformed as well. So we're very happy to report that the CPF portfolios did tremendously well. And it has, looking at the track record, outperformed almost every single year, and it's done really well for us. And so we hope that through our efforts, Singaporeans and Singapore-based investors who are PRs also who have a CPF portfolio, they can achieve good outcomes, consistent outcomes because of the efforts of Endowus, the low-cost nature of our portfolios, the fact that we are globally diversified, and holistic in our approach to investing. So that's the CPF portfolios. And we'll move to the cash SRS portfolios, which obviously has a slightly different construct. But I'm going to pass on to you, Lynn, to take on the tough review of the cash SRS portfolios and the smart beta factors that affect that portfolio.
Sure, no problem. Let's take a deeper look at our cash and SRS portfolio. So for our cash and SRS advised portfolio, the underlying funds in the fixed income asset allocation actually did very well, and it outperformed, the global Bloomberg global aggregate benchmark as well as the emerging market bond index. However, the underlying funds for our equities exposure is slightly lagged the overall benchmarks. And there are several reasons to it. So the underlying funds are the Dimensional Global Core Equity Fund, Dimensional Small Cap PAC Basin Equity Fund, and Dimensional Emerging Markets Large Cap Fund, and as well as the passive Lion Global Infinity US 500 stock index. So this is an extremely globally diversified and sectorally diversified portfolio. And our advice has been, continue to provide investors with exposures to the proven long-term return drivers. So that includes the broad market, of course, and that also includes the risk premiums that comes from factors. So in this portfolio, in the dimensional funds, the funds are actually overweight certain stocks with characteristics such as relatively low price and relatively higher profitability and relatively smaller size. So this has inevitably led the portfolio to be underweight growth, growthy type of stocks. And over the past few years, including the first 2 and 3 quarters of 2020, growth stocks has massively outperformed cheaper stocks. So growth stocks are more expensive stocks, whereas value stocks are cheaper stocks, and growth has massively outperformed value stocks. And this has our overweighting of value stocks and underweighting of growth stocks have led to the slight underperformance of this portfolio. And the next slide shows the comparison of different stocks with different characteristics. So as we can see, for value stocks versus growth stocks, in both large cap and small cap, it has underperformed by quite a bit. However, this obviously raises the question, right? So is this going to turn around? And some people who are more familiar with factor investing or value investing, they would be questioning, whether value is dead, whether this is structural change. And we don't think so, we don't believe so. So the next slide shows the past 90 years of empirical evidence that these premiums are positive over the long term. Yes, it has had, both small and value stocks, they have had a tough run over the past 5 to 10 years, especially over the past 3 years. However, long-term evidence shows us that actually they work over the long term. And they are not only persistent, it's also prevalent across different markets, which makes it more robust. So it exists in US stock market, it also exists in international stock market and emerging markets. There is a high bar to define factor and value premium, and the 3 factors that dimensionals use here, it fit the high bar because it really needs to have both empirical evidence and economic intuition as well underneath. So it hasn't performed for the past 3 or 4 years, but the rebound can happen unpredictably and really quickly. And this is precisely what we observed in October, November, and December, with markets logging really strong premiums over just a handful of trading days. So the next slide shows how strong those factor premium has been just in 1 quarter. So in the 4th quarter, the world equity market has only returned 11%, which is pretty good. But the value index has already come back. it's outperformed, and the small factor, size factor, also like massively outperformed performed the overall market index. And if you combine these two together, it's like super strong, 26.4% versus 11%. We don't know whether this will persist. We don't know whether a rotation is coming, but it persists into at least January of 2021, and with kind of interest rate going potentially like growing up a bit, not a lot. Then like investors are talking about like favoring value stocks again. Bank stocks are performing again. Banks just announced their financial results. And so we don't know, but we are confident for the long-term outperformance of factors.
I think value and these factors are have been a hot topic for us, especially, and we've done many webinars, so please check out other webinars that we have done with guys in the market, which are very interesting, including Dr. Wealth and other guys as well in the past. But I would like to say that there is something called mean reversion in markets, and one of the reasons why value underperformed so much over the past decade, in hindsight, of course, is because of the massive outperformance of value in the previous decade. From 2000 to 2010, value outperformed tremendously. And if you look at the long-term performance of value, the value and small factors, if you look at the really long-term, like the charts that Yulin shared with you, those are the ones that show us that, even in accounting for the past decades underperformance, it's still showing outperformance. And the recent trend is interesting. It's very surprising and interesting. We are not in the business of predicting the future. We're not making a call on the value factor. We're not beholden to factors or smart beta investing. The benefit of dimensional versus purely factor-driven investing, and we've shared this before, is that factor-driven investors only buy value. So a value fund would hold a very concentrated position in maybe 20 stocks or 50 stocks of value stocks only. If you had invested in those value funds, you would have been killed last year, because last year, after 10 years of underperformance, was the worst year for value. But then it came back very strongly towards the end of the year. But the small cap premium has actually held up relatively better than value. And last year, again, as we saw in the US small caps and across small caps around the globe, small caps actually ended up outperforming for even the whole year, and definitely in the second half for many markets. And obviously it depends on the markets that you're in. So I think these factors of value, small, quality, even momentum, these factors are still relevant. It's something that we should definitely take into account when we look at portfolios and building portfolios, to know that where we are overweight and where we are underweight. I think it's important to know that we are overweight value and small and quality in these global portfolios. But for those that are, thinking they're passive but only exposed to large cap US stocks in the form of S&P 500, you need to know that you're underweight small, that you're underweight value, and that you are underweight quality oftentimes as well. But you're overweight momentum, for example. So I think that these are factors to help you understand your portfolio better, so you know how to respond in different market circumstances and different points in the cycle. So the big question that we get asked all the time, so we surveyed our client experience personnel who deal with and interact with all of our client base. And this was the single biggest question everybody wants to know. And it's the single biggest question that we all want to know as human beings. But we have to admit that as human beings, this is the one thing that we cannot do, which is predict the future. We cannot predict the future on anything. We don't know what will happen in our lives tomorrow. But for some reason, when it comes to financial markets and investing in stocks especially, people think that they can forecast and predict what's going to happen in the future. So we've begun the year, and already I'm seeing so many, predictions.
Yes.
Predictions about the future. What are some of the things that you've seen, Yulin?
I've mainly seen positive things. I think most investors, they think that 2020 was so bad that 2021, the global economy is going to experience good rebound.
The vaccines here.
Yeah, and because of vaccine and, they think fiscal policy is still going to be expansionary, which is going to help. So all these sorts of, I think, optimism in the market. Yeah.
But also I've seen a lot of prediction that value is going to come back,
Yes,
or
yeah, I
growth
saw
is
that
going to
too.
continue to outperform.
Yeah.
We still need to be overweight US, or no, it's China,
Yeah.
or predictions about the STI that is actually going to start outperforming, as it very briefly did at the end of the year, but then it's underperformed so much over the long term. So I think predictions are a very commonplace, but it's something that many people are not held accountable for. So many people throw out these forecasts, but they don't at the end of the year look back and say, mea culpa, I made a mistake. I did not predict the COVID crisis. I predicted the markets to go up in a straight line, but it went down 30% and came back 70%. All these things, no one is held accountable. And that's why we need to be careful when we look at forecasts or predictions in the market, because it's unreliable. It's been empirically tested that predictions always almost are wrong. So with that caveat, we're going to take a look at some of these charts to give us a better understanding of what markets are about. So this is the number of drawdowns. So drawdowns means market falls. So it could be any market, but this one we chose the S&P 500 because it has a long history. This is going back to the Great Depression of 1929. So this is more than 100 years, almost 100 years of data that we're looking at. And S&P 500 intra-year drawdown. During the course of the year, how many times did the market go down? How many times did it go down by 5 or more percent? 10 or more percent, 20% or more, 30% or more, or 40% or more. So drawdowns or fall in markets intra-year is commonplace. So a 5% fall, a 10% fall, 20% fall is, a 5% fall happens 94% of the times in every single year. It's very, very uncommon for markets not to fall more than 5%. So if you see a 5% fall, just run-of-the-mill correction. If you see a 10% fall, that happens every other year or more than that. So these are very common occurrences. But what we had last year was a 30% fall, more than a 30% fall. And some indexes fell more than 50%. So this is a very uncommon occurrence. So we need to understand that. This is the other end of the spectrum. Next slide shows us the number of times the market achieved an all-time high during the course of a year. So when I ask this question, what happens to markets when the market reaches an all-time high? And I pose that question to many, many people. Almost always the question is, if it's an all-time high, then it falls. But the correct answer is no. It normally goes on to achieve another all-time high, because markets are skewed to the upside and they tend to go up. And when there is momentum in markets, after achieving an all-time high, the market continues to go up to achieve new all-time highs and do that multiple times. Even in a year like last year, where we had one of the biggest falls in markets, the fifth largest in history, the index achieved 20 different all-time highs. So if you look at the percentage of the days, it's actually, close to 15% of all trading days was an all-time high achieved for another a record.
And I just want to point out, I think it's a very interesting thing because I think when the market is falling, a lot of people will then actually think the opposite. What will happen next? They will not think in the way, it's going to rebound, but it will, fall more. to be more protective. Like, I think we are like inherently really protective of our assets, of our investment. So we kind of generally have this behavioral bias. Yeah.
So it's interesting because when it falls, people expect it to fall more.
Yeah.
But when it goes up, people expect it to fall.
Exactly.
That's
So you
interesting.
always expect it to fall.
So
Yeah.
we call this the climbing the wall of worry, right? Climbing the wall of worry, that the markets go up, but people are continuously worried that there is something or a reason why the market should fall. And so that's why we look at this next table, which is the inter-year drawdown from peak to trough, major drawdowns, and what happens after that. So the biggest falls, as I showed before, from the 1920s to 2008, 30% to 50, 60%, and 86% in 1929. What do markets do after 5 years, 10 years, and 20 years, and 30 years? Really, shows that over the long term, and this is why you should be invested in markets for the long term, is because you cannot time this, but being invested long term really, really helps you, because the next slide shows that, this during that 90-year period, this is what the market did. So it does trend up. Yes, there is volatility. That yes, there are major corrections, but the annualized return is close to 9% or more now. But that's achievable only if you remained in the market during that time and not try to time it. And the next page shows the difference between bear markets and bull markets. So this is a common chart that we've replaced and updated with the most recent numbers in 2020. You can see that blip, 1.1 month of bear market. So the red zone is a bear market. The blue zone is a bull market. And this chart, I think, most clearly shows what markets actually do through cycles, over bull and bear market cycles. And you can see that the bear markets, yes, is painful, yes, is shocking oftentimes, and it was last year again when it fell 33.8%. But look at what happens in bull markets and how it lasts much longer than you think. And even in this recent rebound, again, we've come back quite strongly. And the last slide, I think, is this, cumulative S&P 500 total return. The difference between investing on any given day and what returns were generated 1 year after or 3 years after, versus when you invested only when the market hit an all-time high. The all-time high investments actually did better, which is counterintuitive, right? Because you think that any other day is better than investing at the peak of the market. But what this goes to show is that the peak of the market leads to more peaks in the market, and therefore is not a bad time to invest. So investing on those days actually ended up giving you a better return after 1 year, 3 year, or 5 years, which is a shocking outcome, but a really, really interesting statistic. So let's go back to the economy, because I think one of the other questions that keeps coming up when people ask us these questions is not just about where we're headed, but where we are now. And you can clearly see a continued divergence between the economy and the stock market and financial markets in general. And we need to touch base on some of those fundamental reasons so that we can try to see where the markets and where we should be focused on in 2021. So Yulin will take us through some of these economic macro slides.
Sure. First of all, apologize for the typo. I think it's me. It should be response. But yeah, so the point though is that after COVID happened, one of the reasons that market really bounced back very strongly and quickly is because of the government reactions globally to COVID. And we see that from both fiscal policy front and monetary policy front. So this is the kind of cumulative total economic stimulus that the government around the world has put out to respond to COVID, and it includes different elements such as loans to the SMEs, to companies, such as tax release, such as direct value transfers, and also quantitative easing.
Sorry, before we go on, Yulin, sorry to interrupt, but I think we were supposed to go on to the second poll. So can we actually show the result of the first poll? Because it was a fun poll, the first one. Stocks ended up being 50% how you made money in 2020. That was the session. Stocks was 50%. Endowus, obviously 24% of those who voted probably are Endowus clients. And then bonds, Bitcoin, 7%, government payouts, surprisingly quite a lot, and Tesla, surprisingly low. So in Singapore, I think our exposure to Tesla is relatively lower. But stocks obviously is the single biggest contributor, will be. So with that, we'll close off that poll and we'll launch a new one. So we have a new poll that's just going to be put up. Which asset class do you think would do best in 2021? So the same 4 most popular ones that we could find, stocks, bonds, commodities, and Bitcoin. So please vote on that poll. I'm going to vote now. And I'll tell you what I voted on later on. And then we'll go back to the macro slides.
Yeah.
And we'll come back to the result at the end before we close.
Okay.
But just on this fiscal side, I mean, this is unprecedented. I mean,
It is, yeah.
Fiscal response in 2008, I think, was curtailed by the lack of real impetus and really, yes. I guess, a good enough rationale for governments to open up their purse strings.
Yeah,
Whereas,
and I think they have learned from the 2008 experience as well.
That's right.
I think a lot of them were actually quite conservative in terms of, really spending money and being loose on the fiscal policy. But that didn't help with the economy recovery afterwards, and the economy was scarred for a longer period than necessary. So I think this time, governments around the world, they learned from the past experiences, and pandemic is really an unprecedented event in our life at least.
But it's resulted in this.
Yes, and yes. So yes, we saw unprecedented level of fiscal response from the governments. And of course, one of the consequences of that is debt has just shot up so much. And this is the US public debt to GDP ratio. And it's surpassed 130% already. And it's at the historical high in 50 years' time. And on the monetary policy front, again, we saw, lashing of policy rates around the world. So the US is the blue line, and as we could see, it dropped from close to 2% to almost close to 0%. And there really isn't much room for further loosening of monetary policy, which is another reason for really extreme fiscal expansionary policy as well. Yeah. And I think Sam is going to touch more.
That's basically, in response to this. I mean, the shock to the system was unprecedented. If 2008 was bad, and 2008, I guess, played out in slow motion. It took 24 months before unemployment really hit the floor. Companies took time to, let go of people and find ways to restructure. Some companies tried to survive but went bankrupt 12 months later. But this time was it was just a shock to the system. And I think, any ammunition that we had to be put to use, both fiscal and monetary. But the next slide kind of shows us how policy affects markets. So I wanted to share this with you, how in periods of economic crisis or weakness, we use fiscal and monetary easing, and how that affects financial markets. And it doesn't necessarily lead to poor outcomes. For financial markets, especially equity markets, it often leads to higher earnings or higher valuations. And this is precisely, I think, a point that many economists and strategists would make as we enter a Biden Democratic leadership in the U.S. as of today. I think the inauguration is today, right?
Yes,
so today is an important day in many ways. It's Endowus' first day back as Endowus Live, but also it's Joe Biden's inauguration as president, and the Democratic Party coming back into power at both the executive and also the legislative, as they have the split in the Senate, but also the final vote from the vice president. And when they do that, I think people have realized that this could be policy Goldilocks. What that means is that you have monetary policy, which is at the zero bound, really low interest rates, very accommodative, loose, very strong monetary easing that gives liquidity to financial markets, but also to lending and every other areas of where money makes an impact. And then you have the fiscal expansion, and Joe Biden and his administration have made it a priority to continue to spend, especially because the US is still in the midst of the COVID crisis, to spend to get out of this trouble and ease unemployment and economic slowdown. But they do not have enough political votes and power to pass through the structural changes like raising taxes and other ways in which they could affect the market negatively. And so this term that is being bandied around a lot is policy Goldilocks, where you get fiscal stimulus, but you don't get the taxation and other drags to earnings and individual income. So I think that's a unique set of circumstances that's fueling some more optimism in the market. However, that optimism is being reflected in inflation expectations. So after the huge deflationary, disinflationary shocks in March, you've seen a normalization back up to the 2% kind of break-even inflation rate for 10-year that has been breached now, which is a very important milestone. But the problem is that it's not driven by typically what people like to see, which is economic recovery and an overheating of the economy, which will lead to increase in interest rates. It's actually driven by the fact that it's the demand and supply in treasuries, that the government is having to issue more treasuries and provide more supply in fixed income supply, which is leading to higher interest rates and the burden of servicing this increased government debt. And so inflation expectations are driven by both interest rate movements, but also price movements as well. And therefore, there is a risk that this year we could see some kind of a shock, either from interest rate policy being normalized faster than expected because inflation comes back faster as a result of the economic rebound, although the probability is probably low. Or there is a shock to the system because the US government cannot extend its debt ceiling or something like that. The next chart is an equities chart that we are starting this cycle, even though we've had a massive correction. People forget that we had a correction, a bear market type 20% correction just 2 years ago, 2018. 19 we rebounded. 2020 we had another 30% plus correction. So we've had two bear markets in the space of 3 years, technically. And so we're starting from actually a low base. So even though we've seen a 70% market rebound, we're actually, it wouldn't surprise me if we actually see markets going higher over the long term. But one thing that is limiting is valuations. We are starting at a high point in the cycle. But I think also people must remember that valuations is not a good indicator of peaks or troughs in markets. And valuations will actually come down even if stock prices go up, because earnings will normalize, because we're at a point where earnings are artificially depressed. And so earnings-based valuations are probably not the right way to assess the market's correct valuation. On the next page, just the final point, as a personal investor, you have to understand that trying to time the market just does not work. And what's more important than that, you can get it right once, you can get it right maybe twice, but you have to get it every time. And especially if you're trying to exit the market because the markets are toppish, you have to get it right twice. When you sell it, and then you have to get back in the market, because in the end the markets will go up and make new highs, as we just highlighted today. So if you miss that rebound from the bottom, this chart shows that if you just missed one day out of a 50-year period, your returns fall from 121% to 108%. If you miss 5 days, just 1 week of trading, it almost halves in terms of returns. And then if you miss just 1 month, 25 days, it goes down by 94%, down to 26x, 94x. So it really is very difficult to time the market, and it's only makes sense for you to really, as individual investors, to be rewarded long term by staying invested. The last chart I wanted to show was the new normal. As we talked about interest rates being near the zero bound, interest rates are really, really low. This is July when we launched Cash Smart solution, and it was really to meet the needs of our clients. And Endowus is always trying to meet the needs of our clients, to solve intelligently for your problems, and to provide better solutions and better products at low cost. So with these low interest rates, Cash Smart is another really important aspect of how you structure your short-term liquidity, and then use the core advised portfolios, whether it's cash, SRS, or CPF, for your core advised portfolios, and then use your Fund Smart solution that Endowus has to access best-in-class funds curated for you for satellite positions, or positions that you have certain values towards, such as ESG. So when we launch ESG, we'll let you know, but it will be really, really interesting and exciting, because that's what we believe in as a company, as individuals. We want to express our values and our investments, and create a better world for our children and our future, but also make good returns. It's about generating triple bottom lines. It's not about just sacrificing our returns to do good. There is a way we think that you can generate good returns while doing good. And so ESG and sustainable investing strategies, climate bonds, and other strategies will be incorporated into a holistic ESG portfolio that we will select from the best multi-managers globally. We will do it across assets, equities, and fixed income. And you can target your risk 60-40 or 80-20 or 40-60, and build a portfolio of maybe 3 funds in equities, 3 funds in fixed income, and build a holistic portfolio. And we'll allow that on the Fund Smart platform, so you can buy a single fund, or you can build portfolios with it. And this promotion, I guess, once again, get onto the platform. You don't have much time, 2,000 only, so $100 free for every Cash Smart account that's created. And just one final plug for next week's webinar. Again, these amazing speakers who will be joining us, real leaders of the industry, and people who have great insights about the markets, about the industry, and also how to invest well. And the Eventbrite sign up is below. So please join us next Thursday. We'll be starting at 4 p.m. and we'll have 1 hour panels, so 4 panels in total about the markets, ESG, retirement, CPF, and also personal finance. So we have amazing speakers with us. And we will wrap up with the Slido poll. So let's see how people voted. Yulin, can you?
Unsurprisingly, it's an overwhelming amount of stocks.
Yeah, but the number 2 is surprising to me.
Bitcoin?
Yeah, I guess commodities and bonds is not a very attractive investment. Okay.
And given Bitcoin has done so well this year, I think,
Okay, so we'll just move to Q&A, guys. On Slido, Joseph, are you planning to launch an ESG portfolio? As we just announced, yes. Please look out for that in the next few weeks. We'll have maybe more details at the 28th webinar next week, 28th event next week, but it will most likely be in February, where we'll have the whole portfolio out to you. Let's take one at a time. You choose one that you want to answer, and I'll answer the next one, which is 21 votes. Based on the market sector winners and losers, do you foresee sector rotation in 2021? Resulting in a re-opt in the core portfolio assets. So we are all about being passive and strategic in our asset allocation. We really believe in the science of investing. Proven theories that have have been tested over time and have been proven to be meaningful theories that actually can be applied. One of the most important ones is diversification. We really believe in globally diversified portfolios. And so we want to be exposed to the whole market across sectors, across geographies, across these factors as well. Having said that, if I have to make a personal view, I we're not in the business of forecasting anything. There may be sector rotation, and we're already seeing that. And there may be multiple sector rotations as well. So growth may come back. Technology may underperform for a while, but it will come back. But the chart we showed earlier about NASDAQ beating S&P 500 over the past decade, it was almost every single year. It only underperformed marginally, I think, 2 of the years, but every single year NASDAQ outperformed. So technology is a part of our lives. Endowus is not only a financial service company, but it's a technology company. So technology is something that has always been there. It used to be trains that were innovation and technology. It was the Ford motor car. It was telephones. It was computers. It was technology is a part of our lives. So technology as a sector is a sector that I think will continue to have tremendous value and an important place. It would be very difficult to always pick the winners only. And once again, on something like a Tesla, it's very difficult to say what is the fair value of a company which doesn't generate profits. But I can understand why people are excited about it. I've driven a Tesla and it's great, but also there's a lot of concerns and questions about it as well. So I would always temper any over enthusiasm in any particular sector of stock. But even in things like Bitcoin, I don't have any problems owning any of that.
Yeah, and I just want to add on to that. I mean, yes, technology is very exciting and it's changing our lives, but in terms of investing, the market is pretty efficient and it will have priced in a lot of that enthusiasm and, the positive changes that it has been bringing into our lives and maybe in the future. So, I think to remain disciplined and diversified is still the way to go for the long term.
Okay. Do you want to take any questions or?
Okay,
quick one. Rain, ARK ETFs or unit trust available on platform. Yes, it is going to become available. Nikko Asset Management has a unit trust that wraps it in Sing dollars. As you know, we try to offer only Sing dollars or Sing dollar hedge products so that we can, match asset and liability and remove FX risk for Singapore-based investors. We are trying to negotiate a lower fee to give you better access and higher rebates so that we can rebate it back to you. So please keep an eye out for it. It's not a bandwagon joining kind of investment. We just think it's an opportunity for us to provide best-in-class funds in a particular sector. As you know, we want to offer the best-in-class funds. So instead of going to a broker or a fund platform where you have 2,000 funds from 200 fund managers to choose from, we want to give you the best US growth fund or the best Chinese fund or the best European fund. So we'll curate it for you. We'll do all the hard work of doing the fund manager due diligence, doing the fund due diligence. We have calls with fund managers all the time to try to screen out the best funds, and we'll put that on the Fund Smart platform if they have passed our test, and then we'll negotiate the best price for you so that you can access it at the best price.
Yeah, and another quick one. What are the 3 funds to invest into to have the best exposure to major equity indices? I don't necessarily know why it's like 3 funds, not 2 funds or 4 funds, but I think the starting point is really good. The starting point is to gain passive exposure to, like the major equity markets. And actually our advice portfolio would be a perfect way to gain exposure to not only not only the broad markets, but also, proven factors. So check out our advice portfolio and see whether this is what you want. The dimensional portfolio is really, really diversified. The global core plus the small cap pack basin in total covers over 10,000 stocks in the market, from small cap to large cap, and literally kind of every equity market that you can imagine. So
There's this wonderful question and answer. What made you the most money in 2020? My job. And that's a great answer because for most people it's true. Your job is your biggest source of income and gain. And we always talk about this concept of human capital, how we're converting human capital, financial capital by working and building income. So one of the things that we espouse, and we've talked about this many times in previous webinars, is really focusing on the things that you can control, which is, building your own human capital, improving your personal skills so that you can do better in your job, earn higher income and bonuses, and prove yourself in your job. but also, managing your behavior and, planning out your personal finances so that you plan better. So those are the things that you can control. The things you cannot control is the future direction of markets. You cannot control the outcome of elections. You cannot control which stock will do best this year or which sector will do best this year. So I think leave those things to the professionals, be invested in markets. The worst thing I think you can do is not do anything, or stay out of the market because you're worried it's going to fall, because long term, it's always been proven that that's the wrong strategy. Being out of the market is the wrong thing. Find a balanced portfolio or manage your risk to a smaller level so that you can survive in a crash and then invest more over time. I think that's the right strategy to go. One of the questions at the top I just wanted to answer and get out of the way is, given the market is quite uncertain with low interest, dollar devaluation, dollar printing, high PE, any commodities hedging as part of core portfolios? Long-winded question, but is there a case for commodities? Commodities as a broad asset class is not just a financial asset, because there is underlying fundamental demand and supply. So there's an underlying demand and supply for steel. There's an underlying demand and supply for aluminium, for coffee, or for anything. But there is one asset class which doesn't have. Actually, gold is the same as well. The only thing that doesn't have that is Bitcoin, where there is no real usage or demand and supply. It's just purely financial speculation. Having said that, there is a use case, obviously, and there is a bet against the US dollar, bet against low interest rates. And so commodities as an asset class, conceptually and philosophically, I agree can be attractive. But I think it's such a broad asset class, and oil will look very different from gold, will look very different from steel and aluminium or coffee. So soft commodities, hard commodities, gold or Bitcoin, whatever you want to allocate to, you have to understand the underlying dynamics and not just make it a macro call. Because when you do just the pure macro call, you miss the bottom up. So it's always good to mix the top-down macro view with the bottom-up fundamentals of that single commodity and have a view on that, because just betting on commodities as a broad-based bet is likely to lead to things evening things out and lead to poor outcomes in general.
Okay, and I saw another question which is pretty relevant to us. So I think the question is there any plans to launch new funds on our platform? I can probably give a brief update. Yes, so our Fund Smart platform is a very flexible platform, and we strive to always screen and do due diligence to find the best-in-class funds from different categories of assets and sectors and themes, and make it available to investors, to our clients. And we are constantly doing that and filling the gap. So we will be slowly launching new funds on a regular basis. So look out for our new fund launches, which you will find more information on our websites, and we will also, launch new model portfolios probably with the new funds. So, for example, we are adding a number of ESG funds in the coming weeks, and we will have insights articles and webinars on it as well. Yeah, so look out for it.
So there's a lot of questions on Fund Smart and fees and whether we're including ETFs, et cetera, et cetera. First of all, we're agnostic to product. So as you know, we've always said that the difference between an ETF and a unit trust or a mutual fund is the fact that one is listed and the other one is not. The unit trust mutual fund is an open-ended mutual fund available to retail investors that is unlisted. The ETF is an open-ended mutual fund available to retail investors, but it's just listed on a stock exchange. That's the only difference. The underlying way you manage it, you can have passive index funds, you can have passive ETFs, you can have active unit trusts, and you can have active ETFs. You can have thematic, factor-based, everything. So ETFs, there's more ETFs now than there are the number of stocks in the world. There are so many ETFs with so many different types of ETFs, benchmarked, indexed, non-indexed, active, passive. So ETFs by definition are not passive. you have to understand that ETF is just a vehicle, just like a mutual fund or a unit trust. So select the right funds. If you're going for passive, then choose passive index funds, knowing what you're getting yourself into. So we're agnostic to product. We'll use ETFs if it's a low cost and Sing dollar denominated option. We're working very hard actually with fund managers right now and exchanges as well to try to solve for this problem of bringing low cost Sing dollar denominated ETFs with products that are core, globally diversified, and really low cost. And so we're trying to solve this problem creatively, as Endowus does. Some questions about institutional funds. We're working very hard to bring new funds, as Julian highlighted. We've actually included some new funds, China funds, sustainable equity funds. The big one for us really is ESG. I've highlighted that many times. We've been working hard for at least the past 3 months.
Yeah, like past 3 to 4 months. And I just want to say, if we see a good product that's not available in Singapore or in SGD yet, we actually work really hard with fund managers to bring them to Singapore so that they can be available to Singapore retail investors. And this is exactly what we have done for ESG, which is why, we wanted to do it maybe earlier, but because of the process, because we have to launch new share classes, we have to register the funds in Singapore. It takes a bit longer, but I think we think this is really worth our effort, and we believe in this, and we want to provide the best solution, ESG solution to make it accessible for individual investors in Singapore.
Yeah, and we continue to improve our platform, guys. So there was a question about whether we can create new goals, withdraw and invest in new goals. We've actually made that feature available. So modify goal is a feature that has just gone live on the Endowus platform on Fund Smart. We will soon be launching intergoal transfer. That's coming in several weeks, hopefully. So we continue to upgrade. Our mobile app is out, guys, for those who don't know. So it's not fully feature parity, but you'll be excited to know, and please use it. Please give us feedback. And then a few questions on Fund Smart, and I just want to focus that people look at that and think that it's like Fund Supermart. How is it different? So there are several things and please refer to the Fund Smart launch video and on how it's different. But basically, we and the team, and we have the investment office, we have investment committee working really hard to do a lot of fund due diligence and fund manager due diligence, looking for the best funds. As Julian highlighted, many of them are not available here in Singapore, so we bring them into Singapore. Sometimes we have to partner up with local fund managers to do that. We're trying to solve the ETF problem here in Singapore. So we're creatively solving problems to bring new funds and new solutions. Launching new institutional share class funds. So PIMCO has launched many funds for us that were not available here in Singapore, that we felt was essential to building a globally diversified portfolio. In Sing dollar hedge currencies, UCITS, tax efficient, without having to do FX, so you don't get ripped off by many of these robo platforms or banks who charge you an exorbitant FX fee, both going in and out. So we remove all of that for you and get to a lower net fee and better returns. But one of the most interesting features about Fund Smart is two things. One is that this curation allows you not to worry about whether this fund is suitable for you or not. Because if you want a US growth fund, we would have done all the work for you. We would have looked at the 50 growth funds in US equities for you. We would have done all the due diligence. We would have spent hours analyzing from a financial perspective, performance-wise. We would have talked to the fund manager in the US, UK, or here in Singapore, in Hong Kong, talking to them about how they invest, why they do it that way, the process, the philosophy, the people. And we would have done all that due diligence to select the single fund or the best type of fund for each asset class, so that you don't have to worry about that. And we would go to the fund manager and pre-negotiate that. So that's the curation and personalization effort that we do. But the point for Fund Smart is for us really help you build portfolios. And immediately, even if you do one fund, obviously we'll have the data like every other platform. But what sets Fund Smart totally differently from any other platform out there, because no one else is giving you this, but if you select more than 2 funds, say you selected a 4-fund or 5-fund portfolio on Fund Smart, immediately once you plug in that amount number, we calculate the historical data for the overall portfolio, not single funds, but the overall portfolio, the historical data combined, the 4 funds combined. So you can see the historical data, annualized returns, the worst outcomes, the best outcomes, average outcomes. We simulate the future outlook of where the performance will be in the future as a portfolio. And that's what is the most powerful advisory feature of FundSmart that truly differentiates itself from everybody else. So if you build a portfolio with multiple funds, you can see the complete picture. So it's about that holistic approach to investing that we really want to show you. And over time, we're going to build advice on top of that platform so that you will be able to do much, much more. But with that, I think we're going to have to end our session. Did we show the answer to the second poll?
We did.
We did, yeah.
We didn't show it, but we kind of mentioned it.
We'll talk. We'll maybe briefly show the poll result to end today. So stocks ended up with 79%. Didn't really change. Bitcoin 9%. Yeah. Thank you, and I think we answered most of the questions. I apologize that we ran out of time. We're actually way over time. So we'll try to answer questions. If you have any specific questions related to Endowus, please reach out to support@endowus.com or go to our website. You can call us, you can WhatsApp us, you can leave a Facebook message on Messenger, or visit us at 146B Neil Road. We are here in the office today. Actually, it's been a while since we did this in the office, so it's fun. So thank you once again, everybody, for joining us. It was really great that we could do this again. And we look forward to next Thursday's event where we'll have wonderful speakers join us for what's hopefully a very interesting and helpful event for you all.
Insightful, yeah.
As well. All right. Thank you so much, everybody. Have a good evening.
You.
Thank you for joining us. Bye.
Bye-bye.